Alrighty, so we are live on YouTube. So I'm going to go ahead and go live on this webinar. Okay. Hi, Aaron.
And then Mariano, do you want me to do? Am I the first?
You are, yes. And so we will let this play for a little bit, and I'll chat you here through Zoom and let you know when we'll get started.
Very good.
So we're gonna give people a little bit of time to see our upcoming events.
Okay.
Okay.
Good afternoon, everyone, and welcome. I'm Laura Huffman, President and CEO of the Austin Chamber of Commerce. I am thrilled to have you here today to discuss something that I know has been on all of our minds, and that is the future of our economy. I couldn't be more thrilled to be having this program with you here today. The team has put together an excellent program. We're going to have insights from the most impressive Sarah House, who is the senior economist with Wells Fargo. She's going to be talking to us about our nation's economic recovery, but also she's going to talk about her thoughts on policy and how Austin is positioned. Look, we know this. Running a business is hard, and 2020 has made it even harder. The Chamber is your organization who is singularly focused on economic and health as a driving mission and focus. In other words, you can count on us. And I'm hopeful that you see this program today as part of our commitment to you to make sure that you have access to the very best information to run your business. Through our membership, we connect businesses to vital information and to each other. We're here to tackle the big issues because our business community counts on us to be in the room and influencing. And we expand opportunity by nurturing job growth and helping people to get the skills they need to advance their careers and to provide for their families. I am honored to introduce to you our Chamber Board of Directors Chair, Judge Craig Enoch. He's just in the room right next to me today in the most unusual 2020 format. And the judge is going to share with you some of his thoughts on the specific work that the Chamber has done this year to expand opportunity, even amidst this pandemic. Before we get to this program, I want to recognize the partners and sponsors that have made today possible. I can't tell you how important it is that you have stuck with us and that you continue to help us provide these important opportunities for members. So our 2020 pivotal partners are Amazon, Ascension Seton, PIMCO, and Wells Fargo. Thanks also to our 2020 foundation partners who are listed here on the screen. Again, many, many thanks for your individual and collective efforts to make sure that we all stay connected and smart during this unusual year. Our 2020 corporate partners. These are the companies that help the Chamber provide great programming for you all year long. And I want to thank you personally for your generous support. And finally, today's program is brought to you by our presenting sponsor, Wells Fargo, our reception sponsor, PIMCO, and our panel host sponsor, Amazon, as well as today's corporate sponsors and supporting sponsors, and of course, our media sponsors. And now it is truly my pleasure to welcome Craig Enoch, the chair of the Austin Chamber and managing partner of Enoch Keever LLC, to the stage. Judge, thank you. Thank you for all that you have done in 2020. We appreciate you.
Laura, thank you very much for the kind introduction. When we started this year, Laura and I both started this year. We're brand new to this. Each chair is asked to set up a few priorities for the year, their year as chair. But as they say, you can map out your life, but you better do it in a pencil. 2020 has really thrown all of us for a loop. We're doing a lot more Zooming than we ever thought we'd do. We're kind of learning this new way of gathering separately. I guess I could wander over and bang on the wall and let Laura know I'm over here, but we have separated ourselves for this presentation today. But I'm very proud of the Chamber team, the way they adapted. They pivoted on a day's notice, literally getting us set up in such a way that we can continue communicating, we could continue doing our business, we could continue serving our members in the community, we could continue serving our employees in the community with webinars, with systems, learning about the PPP program, even down to the point of do-it-yourself instructions on masks. We were able to do these things, and it's really the professional staff of the Chamber that has done wonderful things. They even were asked to head up the Restart Business Task Force for Travis County and the city of Austin, knowing after that severe lockdown drove so many people out of business and is still affecting our economy. But getting us back up to speed, getting us started again, learning how to be safe. And in the middle of the spike that's going on this fall that we're seeing around us, Travis County has had better success. I think it's because we got the business community to all start cooperating on masks, started cooperating on remote working, and really working together to get our system up and operating, but in a safe manner. We have Opportunity Austin. I'm so excited to talk to you about that today and to listen to what the economic outlook is for this community. It's very bright, but you're probably aware that the Army Futures Command picked Austin a couple of years ago. We're seeing a lot of movement of employers and employees to this community, new jobs to this community because of that. BAE Systems is one of those, a major employer that's had a huge expansion because of the Army Futures Command. And of course, we can't ignore Tesla, which has announced this gigafactory out here. We're even seeing them asking for skilled workers to apply for battery work. Well, I guess it's not much of a secret that they are thinking about an additional battery factory to support their factory. These are tremendous successes for this region and bringing the region, and the Chamber has always been active in promoting those. When I began my term, I talked about prosperity is the mission of the Chamber. Its mission is to create opportunities, help people live, work, and thrive in Austin. I want to thank you for being part of this webcast, this webinar today. Well, let's hear about our economic outlook. And one of our presenting sponsors, I want to call your attention to Hema Muller. She is with us today, and she's going to start the program. She's with CBS Austin. Hema, take it away.
All right, we're having, well, big surprise. It's 2020. I know that everybody has learned to give us all a little bit of grace when the mute button doesn't come off or the internet cuts out, but something here has happened with Hama. When she comes back, I want her to jump in because she's delightful and I want to give her a chance to say a few words. But let me just quickly move on with the program so that we're respectful of your time. And please join me in welcoming David O'Neill. He's the Region Bank President with Wells Fargo. David, thank you so much for being with us here today.
As business leaders, we're committed to partnering with organizations like the Austin Chamber of Commerce to ensure that you have all the information and data to help Austin thrive. After an historic collapse in activity, the economy's recovery from the coronavirus shock is well underway. However, the second half of the recovery will be more onerous, and it'll depend heavily upon the next steps from fiscal and monetary policymakers, as well as the virus itself. We're thrilled once again to have the experience and expertise of Wells Fargo's Sarah House join us to help make sense of it all. Sarah joins us from Charlotte, North Carolina, where she is a director and senior economist with Wells Fargo Securities. She covers the U.S. macroeconomy, including the labor market, inflation trends, and business investments. Prior to joining Wells Fargo in 2010, Sarah worked as a research associate for the Federal Reserve Bank of Richmond. She also has co-authored 2 books, Economic and Business Forecasting and Economic Modeling in the post-Great Recession era. And she frequently speaks about the economy to national media, including the Wall Street Journal, Bloomberg News, and National Public Radio. Sarah currently serves as the president of the Charlotte's Economics Club and has previously served as chair for the association's healthcare industry committee. Now, as Sarah joins us, it's important to note that although Sarah is a senior economist for Wells Fargo, the company does not dictate nor influence her research or opinions. So now let's please welcome Sarah to the virtual stage.
All right, well, thank you, David, and excited to be here with you and share where we at Wells Fargo see the economy heading this year. So when I was fortunate enough to be with everyone in person last year, I talked about how we were still in what was a record long expansion. And with that, we talked a little bit about how expansions usually end, and with recessions coming about either from some sort of imbalance in the economy that needs to be corrected or some sort of outside shock. And boy, did we soon after get an outside shock in the form of the coronavirus pandemic. So like any downturn, the outlook for the economy will depend heavily on the course of monetary policy as well as fiscal policy. But since this is fundamentally a healthcare crisis as well, it is going to depend on the course of the virus in the coming months. And so with that, there is an unusual degree of uncertainty that surrounds our economic forecast. Now, even with that uncertainty, though, I think what I'd like to highlight is the fact that because we did not enter this downturn with major imbalances. So if you think of where household balance sheets were, even corporate debt, well, elevated, wasn't completely jarring. So that bodes well for the course of the recovery. So we also saw very swift responses from monetary and fiscal policy. And we have had some promising news on the vaccine front as well, which bodes well for the coming year. And so while admittedly, I think the risk of a double dip recession has grown more recently, we still think that we'll be able to avoid another downturn before we even fully recover, and that the recovery should continue on through 2021. Now, when we look at the overall composition, though, we are going to see some variations in terms of different sector performance and different regions, of course. So starting out in terms of our overall outlook for growth. So we have seen the recovery get underway. So after a historic collapse in economic activity, we've seen a nice bounce back thus far, but we've only recovered about 2/3 of the ground lost from the coronavirus recession. So GDP is still about 3.5% below where it was back in the end of 2019. So there's significant ground that needs to be recovered. So to put that 3.5% number in context, so for the Great Recession, you saw GDP collapse about 4%. So we're really not that much in a better position than where we were at the depth of the financial crisis in terms of overall output. And importantly, we're seeing momentum begin to slow. So we have a much slower pace of growth expected in the coming quarters. Although, again, not expecting a double dip at this time. Now, key to that expectation that the recovery will continue is that we've had very accommodative monetary policy. So the Fed came out really guns blazing back in March, took the Fed funds rate down all the way back down to zero, started asset purchases again, and also created a number of emergency lending programs. So both dusting off its financial crisis playbook as well as creating some new programs as well. And so what that did is that helped reverse financial conditions. So this is the Bloomberg Financial Conditions Index. So the higher the value of this line, the easier financial accommodation, easier financial conditions. So that's the cost and availability of credit. And you can see that we saw a quick reversal over the spring. And while credit conditions are generally a little bit tighter than they have been in the past years, this is a far cry from what we saw in the financial crisis. So even though you've seen output decline closely on par with where it is today, this is not a financial crisis. And so that bodes well for the pace of the recovery once we get the virus under more control. Now, how long might the Fed stay accommodative? Well, the short answer is quite a while. So that comes in part because ultimately the coronavirus shock is a disinflationary event. So yes, we've seen some big price jumps in things like grocery store prices, but we've also seen some historic collapses in other items and services. So particularly things related to the travel industry. We've also seen downward pressure in prices for major components of households' budgets like housing. And so overall, we think it's going to be a slow return to 2%, and probably we won't see inflation even hit the Fed's 2% goal over our forecast horizon through 2022. Now, that also comes as the Fed has changed the way it approaches inflation. So no longer does it just want to see inflation reach 2%, but it says that it wants to have inflation average 2% over time. And this comes after a decade in which inflation has undershot the Fed's target. So over the past decade, core inflation has only averaged 1.6%. So even if we were to see an upside surprise in inflation, the bar for the Fed actually removing any of this accommodation is pretty high. And in fact, we think the more likely scenario would be that we see the Fed add accommodation in the coming months, given the fact that that we are seeing some signs of activity slowing, and importantly, we don't have a lot of fiscal support immediately in the offing. Now, the fiscal support we have had to date, though, has been extraordinary and has been a very important component in how swift the rebound in activity has been to date. So in March, we saw the passage of the CARES Act, which of course gave support to businesses via the Paycheck Protection Program, but also extended a lifeline to households in the forms of both stimulus checks as well as additional unemployment insurance benefits, both in terms of the dollar amounts and an eligibility requirement. So quite remarkably, we saw in the spring the loss of 22 million jobs in the economy, which led to a pretty substantial collapse in employment income. We actually saw total personal income increase to where at one point it was about 10% above its pre-crisis peak. So pretty extraordinary considering that historic loss of jobs. Now, the problem is that we are seeing that fiscal support fade. So some of those additional, the top-ups to unemployment insurance have expired, and some of the programs overall are set to expire at the end of the year. So even, so reducing that, who can benefit from even a smaller amount of payments. Now, we still have income about 3.5% above its pre-crisis peak, so we're still doing okay on the income front. But the fact that you are seeing that fiscal support fade, and really it doesn't seem like there's going to be a deal between now and probably late January, it does mean that the spending picture is set to slow over the coming months. Now, we don't think that this will cause a double-dip recession, and in part that's because that the fiscal support to date was so substantial that you still have households saving at an exceptionally high rate. So the household savings rate is still over 14%. So that's almost twice as high as it was in 2019 before the pandemic. And so when you look at the accumulation of savings over the course of this year, households have about $1.3 trillion more dollars in their bank accounts that's available to be spent should conditions improve. And so we think that there's enough wherewithal to keep spending on track and get the economy to the other side of this virus, even as we don't have additional fiscal support coming down the pike immediately. Now, importantly, though, that the outlook will depend on the course of the virus in the coming weeks and months. So we are in the midst of a third wave of cases nationally. So both, so not just cases, but also in terms of hospitalizations and unfortunately fatalities as well. Now, in Texas, things have been a little bit better under control. We're still not back to what we saw in terms of the midsummer wave. But we are going to see, we think, behavior change as a result, even if you don't see widespread restrictions like we saw last spring. Now, already we are seeing some localized restrictions in different states and localities, so that's having an impact. But consumers are also apt to change their behavior as well, which will weigh on activity in the near term. Now, the relationship, though, between virus cases and even hospitalizations and activity, it is weakening. So we've seen as we learn more about the virus and people feel a little bit more comfortable in how they can still go about and engage with others in the economy in a somewhat safe way, businesses have learned to adapt and make their customers feel safer. We haven't seen as stark a move in terms of virus cases and actual activity. So if you look at some high frequency gauges of activity, you can see that time spent away from the home is still weaker. So people are still spending much more time at their houses than they were prior to the pandemic. But even as we've seen this big wave over the past few weeks, we've only seen a gradual increase in people staying at home in the United States. So in Texas and Austin, where things have been better controlled, so we really haven't seen a change in people venturing out. Similarly, if you look at seated diners as really a proxy for discretionary spending. So we're seeing a little bit of a pullback nationally, but not so much in Texas and Austin, where again, recent caseloads have not spiraled to the extent that we have seen nationally. Now, of course, activity is going to depend heavily on what industry you're in and how that responds and how that's positioned to deal with social distancing, whether it's a non-discretionary, discretionary type of item, but also what region you're in. So Austin was an outperformer and a high flyer before the pandemic, and the pandemic hasn't changed that. So while Austin hasn't been able to escape the downturn that we've seen nationally, it's been much more modest than it has in both Texas and the United States. So for example, if you look at employment, so this chart here shows a 3-month moving average, but if you just look at where jobs are in September relative to a year ago, they're only down about 2.5% in Austin. So that's pretty good when you consider nationally they're down about 6.5%. In fact, if you look at all of the nation's 50 largest metro areas, Austin's actually had the most modest decline in employment. So why is that? Well, part of it relates to the region's industry structure. So we've seen over the past few years, tremendous growth in areas like professional and business services, financial activities, information, all of which are industries where it is relatively easy to work from home. And so those industries have been much more insulated from the COVID shock. And in fact, if you look at nationally, you've seen employment decline across every industry. But even within those, even within the industries that Austin has a relatively big share of, like professional and business services, we've actually seen employment increase over the past year. And so part of the outperformance is that industry structure where you do have a lot of folks who can work from home, but it also comes to the extent of the expansions, the relocations that Craig mentioned at the start of the program as well. So you still have companies looking beyond the pandemic and their long-term growth needs, and Austin remains an attractive place to invest and grow your business. So in many ways, the pandemic is a pretty level playing field where every region is dealing with this. Now, the fact that we've seen employment hold up better in the region, as well as that strong fiscal stimulus, has helped the consumer spending actually increase relative to the start of the year in Austin. So this is a pretty remarkable feat, and you compare spending in the area across a number of peers. So whether it's other metro areas in Texas or even just the United States. Pretty rare to see. I think the fact that you've seen an increase in spending really speaks to the relative strength of the Austin economy. Now, one factor to point out, though, and while we don't get a breakdown of types of spending at the metro level, we do know from the national numbers that we've seen very different performance in terms of goods spending versus services. So, need to social distance has hit services particularly hard. So you can see services spending is still down about 7% from where it was before the pandemic. Highly unusual in a downturn. So usually households are apt to pull back on big ticket purchases, like cars and RVs and other things for their home. But of course, the need to socially distance has really flipped everything on its head, and we've seen strength in goods spending. And with that, though, it means that more of that spending is flowing outside the area. So your local businesses tend to be more service based in terms of. So you tend to see your local businesses skew toward services, and with that, we have still seen some pressure on the number of businesses open. So even as we've seen generally strong employment and spending, we've seen disproportionate hit in terms of the number of small businesses open. And that's particularly true when it comes to services industries, but leisure and hospitality, where again, it's very hard to safely engage with other folks. And of course, for some households who have seen their income hurt, these tend to be more discretionary services. And so I think we have to think about what the local business community and economy looks like on the other side of COVID, given this disproportionate hit to small businesses, and kind of what the local economy's landscape will look like on the other side of COVID. Now, another way in which things will be changing is in terms of the commercial real estate market. So talked about working from home in terms of how that's insulated in employment, but of course, on the flip side of that, it's put a lot of pressure on demand for office space. Now, I don't think we'll all be working from home forever, but we will probably see a higher prevalence of working from home as employers have gotten more comfortable with it through the pandemic. And so that's going to limit demand for office space going forward. And we would expect to see vacancies rise further and further downward pressure on rents. Now, if you look at spending patterns and the fact that the COVID has really accelerated the shift towards e-commerce, that's playing out in terms of the industrial and retail market. So this was a trend that we were already seeing in terms of relative strength in industrial as more and more shopping moved online. But COVID has really lit a spark under that. And so we've seen that trend accelerate, where even as we've seen vacancies pick up and some pressure on rents, that we think that this is probably just that this is probably a brief disruption, and that you should see relative outperformance in industrial and continued pressure on your more traditional retail space. Now, when we look at what's happening in the residential market, so apartment market, we've continued to see a lot of new construction, even as you've seen some pressure on rents, and we've seen renters get hit disproportionately if you think about the composition of job losses. So all those closings of leisure and hospitality firms, your restaurants, your recreational activities have hit those workers much harder, and they tend to be lower income and therefore more likely to rent. And so that's put some upward pressure on vacancies, downward pressure on rents, but we've still seen some pretty strong construction in terms of the multifamily space in Austin over the past year. So permits are actually up about 60%. We've also seen continued strength in single family. So single family construction is up about 10%. So some really strong trends in terms of construction, which is good for the near term when you think about this is investment, these are construction jobs, but it also helps with the region's longer term growth prospects as well. So house prices have largely been outpacing income in the region over the past couple of years, deteriorating affordability. And we've seen price appreciation accelerate again as the pandemic has really led to a surge in demand for people want more space. Mortgage rates have fallen dramatically. And so that's helped spark sales activity as well. But the fact that we are seeing pretty substantial construction is poised to at least mitigate that erosion in affordability. So part of the reason affordability has been such an issue is that we've had such strong population growth. So the population data only goes through 2019, but you can see that particularly in migration, so more people coming from outside the region wanting to live in Austin, be part of the community, has led to this surge in demand for home that construction really hasn't kept pace. But with this continuation of construction, even in the midst of the pandemic, we've seen that the construction picture and the housing supply picture continues to look a little bit better. So our estimates, based on what we've seen in terms of permits to date and recent trends in population growth, suggest that housing per capita, new construction is close to its highest level since the mid-2000s. And so that will at least help in terms of that affordability issue, and continue to make Austin a very attractive place to live in the coming year. So that's important for the region's longer term growth. So the fact that you are still attracting people, that's your local labor force, that's your source of local spending. And so I think we've continued to see some positive trends on the housing front, in addition to the relatively stronger performance in employment. So overall, Austin remains in a very strong position as we head into 2021. It's weathered the COVID storm exceptionally well when you compare it to a lot of other areas. And I think the recent weakness that we've seen in the economy is really an outfunction of that pandemic. And once we get the virus under control, it's going to be another great period for Austin. So I will go ahead and stop there and turn things over to Hema if we have sound.
All right, Sarah, it looks like we're having some audio problems. Can you hear me? Sarah, can you hear me?
I can hear you, yes.
Okay, great. Listen, that was great. I learned a lot just now looking at that analysis. We have had some questions come in, so let's just take a few minutes to see what's on people's minds. First of all, we've all been reading about the vaccines. There are 2 vaccines that are quickly making their way to market. I think we all understand that they're going to go to vulnerable populations and frontline health workers first. But what have you built into your economic forecast around the availability of the vaccine for 2021?
Sure. So we think that a vaccine will be widely available by the second half of next year. So I think that contributes to this story that we're going to see probably momentum continue to slow over the next couple of months as, again, that fiscal stimulus fades, those virus cases mount. But I do think there's a chance that we see activity accelerate in the back half of the year as we are anticipating that vaccine to be more widely available in the second half.
Okay. Another question, it's kind of an observation, and they just want to clarify you. One of our guests on this call wants to understand that the positive outlook that's coming from the top 25% of earners is creating the growth. So that's a clarification, yes. Lower earners are actually worse off than they were during the financial crisis. Is that accurate? And is there going to be a correction there? What would it take to get a correction?
So I think it's hard to tell exactly the breakdown. So yes, I think that you're going to see spending in aggregate continue to improve, largely driven by your higher income, more affluent households who have been able to save. It's still hard to tell if lower income households on net are worse off. So certainly they've borne the brunt of job losses, but the fiscal response has been much more robust to those households than it was following the great financial crisis. And while, again, we're not expecting another fiscal package probably until at least January, there has been tremendous support thus far, and there is still a good chance that we get some additional support. And so while this pandemic has certainly been much harder on your lower income households and your lower income earners, it's hard to say if they're worse off relative to coming out of the Great Recession, particularly considering that financial conditions remain more accommodative and support a faster snapback, which should hopefully limit that scarring in the labor market.
Okay, thank you for that. And then last question, and then we'll move on to our next speaker. But Sarah, thank you for this. Let me ask you just really quickly before I tee up the last question. There are a bunch of questions that are coming in. Would you be willing to work with us so that we can get your answers to these questions and get them back out to people that have?
Of course, happy to.
Okay. All right. So that's our promise to you. If you're out there and you've asked a question, we will capture all these questions, work with Sarah on answers as well as our next speaker and get them back out to you. So last question for you, Sarah, is it looks like you guys are a little bit bullish on the vaccine in the second half of 2021. Is there anything else that you're worried about that keeps y'all up at night that might be threats to recovery?
She says.
So I think first and foremost, it's certainly the virus. I think what comes next is perhaps the fiscal overhang. So I think while the tremendous fiscal response has helped us get us through this pandemic, so we are going to have to contend with that debt further down the road. And so do we see some dislocations in the market trying to absorb absorb that debt. The Fed, while they've been very supportive to date, they don't have a lot of tools left. And so if we were to get either some additional shock or see other imbalances grow, monetary policy is in a pretty tight spot right now.
Okay. And then somebody's dying to hear, because I know we all love graphs so much, and we've heard that the recovery is going to be K-shaped. And by that, we mean some people are going to recover first, strong and fastest. Others, like the entertainment industry, the tourism industry, is going to recover much slower, and in some cases not at all, thusly making the K shape. Is that what you were describing here, essentially?
So I think the K shape is pretty dire in terms it implies that the lower income earners are doomed for eternity. And I think, once we get that vaccine, households still have a tremendous amount of savings. I think people are going to be eager to get back out there once it is safe to do so. And so I think you really could see a flurry in hiring activity once it becomes safer for folks to get out and about. And so I do think, while again, this recession has been disproportionately hard on those lower income households and job earners, I don't think that this is a forever scenario. And I think you will get a turnaround and some convergence in terms of the jobs outlook in the second half.
Thank you for that. Silver, we're looking for all the silver linings we can get. So I appreciate that, Sarah. Sarah, thank you for that in-depth review of the economy. We're going to move on now. I want to introduce Stephen Buchan, who is the head of the non-acute healthcare at Amazon Business. In his role, he defines the Amazon Business go-to market strategy and program execution for non-acute healthcare corporations across the U.S., led by the Amazon Business Non-Acute Sales Organization. He also supports the strategic development efforts across the Amazon healthcare ecosystem. Stephen, welcome, and thank you so much for joining us today.
Thank you so much, Laura, and thank you to the Chamber for having me today to speak a little bit about how Amazon has navigated through the COVID-19 pandemic. I'd say broadly, Amazon has navigated very well. We've become more essential than ever to everyday consumers in the midst of the pandemic as we spend more time in our homes, and the need to have supplies delivered safely and effectively is as high as it's ever been. But I think few people realize the adverse effect that the pandemic has had on many of Amazon's B2B segments. One of the largest of those is Amazon Business, and it's the marketplace that organizations across the globe and across many different verticals use to procure supplies to run their day-to-day businesses effectively. And as COVID has compelled many of those customers to either close their doors or send their employees to go work from home, you've seen the demand for those supplies really diminish. And it's been a massive challenge for our business in the first half of the year. But Amazon is known for a relentless focus on its customers and working backwards from their challenges. This is where the Amazon healthcare team, I think, has done a phenomenal job identifying the overwhelming demand for personal protective equipment and really getting some early signals around the breakdowns in those supply chains. And it's ultimately what our healthcare customers needed to protect themselves and protect their patients. Prior to March, this was not a core competency for Amazon. Your average healthcare system was not typing into their Amazon search bar consumable medical products, but we needed to make it a core competency if we were going to be there for our customers and ride through this pandemic together. So what did we do? We innovated on our customers' behalf. And the result of that was the COVID supply store. It's a storefront that was designated for frontline healthcare and government organizations, and Amazon teams across the globe worked tirelessly to go source those critical supplies and get them into the hands of the providers who could do the greatest good for the greatest number of people. Amazon Business was ultimately able to provide over 100 million units of this scarce PPE to 46,000 frontline workers. This included half of the US top 100 health systems, 36 US states, and ultimately expanding to an additional 8 countries in the process. It's an amazing example of innovation in unprecedented times to grow a thriving business. You know, I'd like to really conclude, though, by highlighting how Amazon has prioritized its people. My once in-person staff has been completely remote since early March and will continue to do so for the foreseeable future. And as referenced on our recent earnings call, Amazon expects to invest over $10 billion in 2020 alone on COVID-related initiatives to keep our employees safe. I think it's important to recognize, because if Amazon is going to navigate this pandemic or whatever comes next, as well as it has over the last 8 months, it's going to be through its people and their relentless energy to go innovate on behalf of our customers in the way that we have. Again, I want to thank the Chamber for the time today. It's been an honor. With that, I would like to turn it over to Brian Kyle. He's the Vice President and Regional Head of Internal Sales for PIMCO.
All right, thank you, Stephen. On behalf of PIMCO, our entire office here in Austin, I want to extend a big thanks to you and to the Chamber. It's a real pleasure to yet again have the opportunity to participate in today's Economic Outlook event. As mentioned by many of our speakers, this year has certainly presented some unique challenges for investors. And at PIMCO, we're really grateful for the opportunity to be here, to provide you hopefully with some insights that'll help you navigate the end of the year and 2021 looking forward. And while the current environment can be unsettling for many, a silver lining is that volatility and uncertainty can often lead to attractive investment opportunities. I can think of no one better to follow Sarah's great comments and lead us through the second half of our conversation than PIMCO's Aaron Brown. By way of background, Aaron's a managing director and senior portfolio manager on our global asset allocation team based in our headquarters in Newport Beach. And prior to joining PIMCO, Aaron was the head of asset allocation at UBS Asset Management and has held various portfolio management roles at UBS O'Connor, Point72, Citigroup, More Capital. It goes on and on. Aaron's going to touch on 3 key points with us today: potential opportunities across asset classes, how being active within portfolios can help us navigate the winners and losers of this recovery, and then finally, why portfolios that are thoughtfully constructed, well-diversified, and nimble will likely be in the best position to navigate the road ahead. With that, it's my pleasure to introduce Aaron Brown.
Thanks, everyone, and I really appreciate everyone's time today. You know, I really wanted to pick off where Sarah left off with regards to how we're thinking about really navigating the next year ahead in the macro environment, and how we're thinking about many of the themes that she touched upon on how we're investing across multi-asset portfolios. You know, we've moved over the last couple of months from the acute to the chronic phase of the economic recovery. And from here, while we expect that the recovery will be more gradual and certainly more bumpy over the months ahead, we also believe that as the gradual reopening is met with temporary setbacks along the way, with the vaccine on the horizon, we expect that over the next few months, we are going to start to see more of a cyclical recovery start to pick up. And I think what's important to note is that we've seen an enormous amount of both monetary and fiscal stimulus that's been pumped into the system over the last 8 months. And that this is really underpinning what we think will be an optimistic growth environment for next year, albeit there are risks certainly around that forecast. There are 2 structural changes that have emerged, and Sarah certainly highlighted this in her comments over the last 8 months. And I think that these structural changes that have emerged in the global economy are likely to have lasting impacts both on the global economy as well as in markets until well past the pandemic. The first is that we saw pretty extraordinary fiscal action by governments across the globe that have stimulated their economies. And similarly, in dovetailing this, has been very enormous monetary policy easing, which has also been enacted over the last 8 months. And we think that going forward, importantly, we are going to be running with much wider fiscal deficits and much larger central bank balances over the secular horizon. And this will have pretty impactful meaning for risk assets and how we're trading our global market portfolios. In monetary policy, we saw the Federal Reserve here in the US make 2 pretty powerful changes to their policy framework over the last few months. The first is that they adopted a flexible average inflation targeting, which basically means that they're willing to allow inflation to run above the 2% inflation threshold during periods of strength in order to accommodate or compensate for periods where inflation runs below 2%. Also, importantly, the Fed also announced that they're not likely to raise interest rates just when the unemployment rate reach the lower bound, which means that they're likely to also rely a lot more heavily on inflation and making sure that inflation is persistently at the 2% inflation level before they start to raise rates again. And so what this ultimately means is that the Fed going forward, as similar to other global central banks, will likely take a much more gradual, a much more slow approach to the way that they raise rates going forward. And the outlook for that means that the Fed, in our case, is unlikely to even think about raising rates over the next 2 years. Similarly, we've seen an enormous amount of fiscal policy been pumped into the system over the last couple of months, which has led to about 20% of aggregate GDP in fiscal stimulus measures being announced across the US, Europe, UK, as well as much of Asia. And so the very expansionary fiscal balance sheets combined with very expansionary central bank balance sheets does underpin a strong growth outlook for next year, particularly as we move past the pandemic and have a vaccine in place. You know, certainly we've seen equity valuations move towards, expensive territory. But we think that even though equity valuations look rich on an absolute basis, we think that low interest rate policies coupled with a cyclical recovery in global economic markets will lead to continued outperformance of equities. And we're targeting equity earnings in the range of about $170 per in the S&P 500 next year, which will lead to S&P appreciation in the in the high single digits, low double digits in 2021. So still a pretty robust outlook for equities next year. What I think is different though, in terms of how we've been positioning our portfolios of late, is that we're starting to move our equity portfolios to be positioned to take on a little bit more cyclical risk in our portfolios. So early in the pandemic, we were very defensive and buying sort of the highest quality companies in the S&P 500 and really focused on the US relative to the rest of the world. Now that we're starting to see growth start to percolate and we're starting to see an inflection point in the global economic recovery, we're starting to take a little bit more cyclical risk in our portfolios. And what this means is that we're starting to buy industrial manufacturing cyclicals like the industrial sector, like metals and mining, like materials, as well as semiconductors, that we think will do well as we sort of move through the next several months. We're still relatively cautious on the service sector. As Sarah sort of highlighted, the service sector has been persistently underperforming during this recession given mobility restrictions, and we think that that's likely to stay in place until we have widespread adoption and availability of a vaccine. So we do think that that will be the next leg of the recovery, but we think it's a little bit too early to be really buying those sectors of the economy as of yet. What we do, though, think is starting to look more optimistic is the recovery for small and mid-sized businesses, and sort of smaller cap equities have outperformed over the last 2 months. And we think that as this recovery starts to broaden and starts to deepen as we move into 2021, this does augur well for small cap equities. And so we think that that is one of the areas that will likely outperform in this next leg of the recovery. As we turn to rates, we think that the rate environment over the sort of next couple of years is likely going to be really driven by muted inflation expectations and very accommodative central banks, which will likely keep government bond yields quite low and range bound over the next couple of years, even as the recovery continues. We've been in an environment over the last 10 years that where potential growth has been quite good. Realized growth has been quite good relative to potential growth. And yet, even despite that environment, we've persistently seen inflation disappoint relative to expectations. And so the Fed hasn't yet been able to engineer the targeted 2% inflation to persist over time for the US economy. And the same is true even more so if you look at Europe and Japan and other developed market economies. And so what this means is that we're likely to see a very gradual, very slow Federal Reserve, as well as other global central banks. And this will keep rates fairly range bound over the next several years. If we were to see economic conditions worsen, we'd probably likely see more action on the fiscal side, given that rates are already close to the effective lower bound, and we think that negative rates in the US are highly unlikely. But we think that by and large, our base case is for a pretty muted and pretty range bound environment for rates in the US. And so that actually is a pretty bullish argument or pretty bullish environment, if you think about it, for equity assets and for risk assets. In an environment where you're starting to see the global economy recover, where mobility restrictions will be, slowly reduced as we move towards a vaccine next year, and where monetary and fiscal policy are going to remain quite accommodative, that sets up for a good base case for risk assets and for the economy on a broader basis. And so we think that those sort of material shifts that we've seen and are continuing to see unfold will lead to a brighter spot for 2021 as we navigate over the months ahead. Lastly, as we think about the dollar, for those of you who are focused on sort of the currency exchange rate, our base case is for a dollar depreciation to continue and to really broaden as we move into 2021. And this really is going to strongly favor other cyclical currencies in the developed markets, like Europe, like Norway, like Sweden, like Australia, like New Zealand, which we think are going to benefit from a cyclical recovery in the global economy, which will benefit those more export-oriented FX currencies. And broadly speaking, we are expecting that the dollar will start to sort of depreciate in sort of the mid-single-digit range over the next 2 years on an annualized basis. The biggest risk to our views right now is really over the short term. And that's specifically the risk of a double-dip recession, which we don't think is likely, but we are certainly seeing a slowing of economic activity as we move towards the winter because of COVID concerns. In addition to that, fiscal action right now remains pretty lackluster and unlikely in a lame duck scenario, so we'll likely have to wait until January or February to have any additional fiscal action. And we are expecting one additional COVID fiscal bill, albeit smaller than what would have been envisioned under a Democratic sweep. We're expecting about $1 billion to be announced. To date, markets have not really been concerned about the lack of stimulus, given the improvement that we've seen in US economic data strength. However, the labor market certainly, and the service data is going to be really important to watch as we move over the next couple of months before a vaccine's been announced, because those have, if we start to see economic data slow and we're in a little bit of a vacuum with respect to the vaccine adoption and fiscal stimulus bill, we could start to see equity markets weaken, although we would think that that would be quite temporary in nature. So with that, I'll just stop here and see if there's any questions, or I can certainly dig deeper into any of the themes or any of the views that we have of PIMCO.
All right, Erin, thank you so much. That was an unbelievable amount of information. I appreciate that. And by the way, congrats to Wells Fargo and also to PIMCO for hiring 2 hotshot women who know exactly what's going on in our economy. That's really fun for me to see. And by the way, I've gotten several texts from folks that are watching this that it's really good to see a couple of young women that are just knocking it out of the park. So Sarah and Erin, thank you for what you've done for us today, and keep going. You're doing a great job. So we're going to wrap it up. Here's what I want to offer to you. Sarah has already agreed, and Erin, I'm hoping you'll agree to do this too. We've got lots of questions rolling in, and if you will work with us, then we'll put together a full-blown Q&A for this audience so that people can continue digging into your expertise and continue asking their questions. So if you've got a question on your mind, now's the time to throw it into the chat or onto the YouTube, whatever format you're using. And by the way, I think we're using everything under the sun right now. Do so. And our commitment to you, this is part of what we do for business in Austin. We'll continue this conversation. There's nothing more important than this conversation. So Erin, thanks a bunch. Really appreciate it. Sarah, thank you. Wells Fargo and PIMCO again, way to knock it out of the park there. And I want to thank everybody that joined us for this program today. Our speakers, our sponsors, our audience. We have some great events that we're going to be sponsoring before the end of the year. So here's what I want you to put on your calendar. On Friday, we're having a conversation with the airport and with Southwest about the future of air travel. So here's why you care about that. One, you want to find out whether it's not safe for you to go anywhere or anybody to come see you. And the second thing is, this airport is a huge piece of our infrastructure picture as we attract, recruit, and grow businesses in Austin. So whether it's for personal reasons, community reasons, or business reasons, you're going to want to tune in on Friday. And then at the end of the month, we're going to be hosting our annual Regional Mobility Summit, where we're going to talk about progress that our community has made in transportation. Again, infrastructure is a huge reason why people consider growing, relocating their businesses to our area. So please plan on attending this so that you can be all the way up to speed on what's going on, including a post-election report out on Project Connect. And in December, we're going to wrap the year up with our annual Greater Austin Business Awards. So you're going to want to come celebrate with your colleagues, celebrate yourselves. Look, we're almost there. We almost made it. 2020 has been a doozy. You guys have done an amazing job of staying connected to us, making sure we know what's important to you, making sure that our members have all the information they need to be as successful as possible. So thank you so much for joining us today. And you guys have a great rest of the week. Thank you.